Hello, and welcome to our series on a topic that is quietly yet profoundly changing the way we interact with our money every single day. We're talking about artificial intelligence and its revolutionary impact on personal finance here in the United States. If you've ever felt overwhelmed by budgeting, confused by investment options, or simply wished you had a smarter way to manage your financial life, then you are in the right place. Over the next several chapters, we will explore how AI is moving from the realm of science fiction into the palm of your hand, empowering you with tools and insights that were once reserved for the wealthiest individuals and largest financial institutions. Before we dive in, it is absolutely crucial to establish the purpose of this series. The information provided here is for educational and informational purposes only. This is not financial advice, investment advice, legal advice, or tax advice. The world of finance is complex and highly personal. We will be discussing tools, technologies, and trends, but we will not be making recommendations on specific products or strategies. Always consult with a qualified and licensed professional, such as a certified financial planner or a certified public accountant, before making any financial decisions. Our goal is to empower you with knowledge, so you can have more informed conversations with those experts and make the best choices for your own unique situation. With that important understanding in place, let's begin. So, what exactly do we mean when we say artificial intelligence in the context of personal finance? The term AI can often bring to mind images of super smart robots or complex, futuristic computers. In reality, the AI we're discussing is more practical. Think of it as a set of powerful computer programs designed to perform tasks that typically require human intelligence. This includes learning from data, recognizing patterns, and making predictions or suggestions based on that information. In finance, this breaks down into a few key areas. The first is machine learning. This is a subset of AI where systems learn and improve from experience without being explicitly programmed for every single scenario. For example, when your banking app automatically categorizes a grocery store purchase as groceries, that's machine learning at work. It has analyzed thousands or even millions of transactions to learn that a charge from a specific merchant likely belongs in a certain category. It's not just following a simple rule, it's learning and adapting. Another key component is data analysis. We live in a digital age where every swipe of a card, every online payment, and every direct deposit creates a digital footprint. Individually, these are just data points. But when analyzed together, they tell a story about our financial habits, our income, our expenses, and our goals. AI excels at sifting through this massive amount of data to find meaningful patterns that a human might easily miss. It can spot trends in your spending, identify potential savings, and forecast your future cash flow with a surprising degree of accuracy. Let's contrast this with the traditional way of managing personal finances. For decades, the standard approach involved manual data entry. You might have used a physical ledger, an envelope system for cash, or later, a computer spreadsheet. This process was time-consuming, prone to human error, and fundamentally reactive. You were always looking backward, at what you had already spent last week or last month. Financial planning was often an infrequent event, something you did once a year, or only when a major life event occurred. AI has flipped this model on its head. It transforms personal finance from a reactive chore into a proactive, real-time experience. Instead of you manually inputting every transaction into a spreadsheet, AI-powered apps connect securely to your bank accounts and do it for you, instantly. Instead of you trying to remember if you've paid a bill, these systems can track due dates and send you predictive alerts. This shift from manual to automated, and from reactive to proactive, is the cornerstone of the AI revolution in personal finance. Think about fraud detection, one of the earliest and most successful applications of AI in finance. Your credit card company's AI system analyzes your typical spending patterns, where you shop, how much you usually spend, and at what times. If a charge suddenly appears from a different country for an unusually large amount, the AI flags it as suspicious in milliseconds and alerts you. This system is constantly learning and protecting you in the background, a silent guardian for your financial security. This same pattern recognition capability is now being applied to help you understand your own habits, not just to catch criminals. The power behind this revolution comes from the convergence of several technologies. First, the widespread adoption of online and mobile banking has created a steady stream of digital financial data. Second, the availability of immense computing power through the cloud allows companies to process this data on a massive scale. And third, advancements in algorithms have made AI models more accurate and efficient than ever before. In the upcoming chapters, We will break down exactly how this technology is being applied across different facets of your financial life. We will explore AI-driven budgeting and savings tools that act like a personal financial coach. We will look into the world of robo-advisors and how AI is changing the landscape of investing, making it more accessible to the average person. We'll discuss its role in credit scoring, lending, and even how it helps in identifying ways to manage debt more effectively. Our journey is just beginning, but the core theme is clear. AI is democratizing financial intelligence. It's providing everyday individuals with a level of insight and automation that was previously unimaginable. It's not about replacing human advisors, but about augmenting our own ability to understand and control our financial destiny. Join us in the next chapter as we take a deep dive into the first and most fundamental area of personal finance: smart budgeting and expense tracking in the age of AI. Welcome back. In our last chapter, we introduced the broad concept of artificial intelligence and set the stage for its growing role in personal finance. We talked about a fundamental shift from a reactive to a proactive approach to managing money. Today, we're going to dive into the most foundational aspect of anyone's financial life: understanding where your money comes from and where it goes. This is the world of budgeting and expense tracking, an area that, for many, has historically been a tedious but necessary chore. For generations, the tools of budgeting were simple: a notebook and a pen, envelopes stuffed with cash for different spending categories, or more recently, a complicated spreadsheet. The process was entirely manual. You had to save every receipt, sit down regularly to enter every single transaction, and double-check your math. It was time-consuming, prone to errors, and you were always looking in the rearview mirror, analyzing spending that had already happened. AI is completely transforming this experience, turning the dreaded task of budgeting into a seamless, automated, and insightful process. The engine driving this transformation is a technology called automated transaction categorization. Modern budgeting applications that use AI can, with your permission, securely connect to your financial accounts, like your checking accounts, savings accounts, and credit cards. Once connected, they automatically import your transaction data in real time. But here's where the intelligence comes in. The raw data from a bank statement is often messy and cryptic. A charge might appear as TRNSFRSQR *My Coffee Shop 123, Main Street. To a human, this is confusing. To an AI, it's a puzzle to be solved. Using a combination of machine learning and natural language processing, or NLP, the AI system analyzes this text. It identifies key elements like the merchant's name, location, and the type of business. It compares this information against a massive database of millions of other transactions. The system concludes that this cryptic line item is, in fact, a $5 purchase from your local coffee shop and automatically categorizes it under food and dining or coffee shops. This happens in seconds, for every single transaction, across all your connected accounts. What makes this system so powerful is its ability to learn. Let's say you buy crafting supplies from a large online retailer, and the app categorizes it as general merchandise. However, you have a specific budget for your hobbies. You can manually change the category of that transaction. The AI takes note of this correction. The next time a similar purchase occurs, the system is more likely to categorize it correctly as hobbies. It adapts to your specific financial life, becoming more personalized and accurate over time. This continuous learning loop eliminates the hours of manual data entry that made traditional budgeting so difficult to maintain. With all your financial data automatically categorized, the next step is analysis. This is where AI moves beyond simple organization and becomes a powerful tool for insight. Instead of just a long list of transactions, AI-powered platforms present your financial picture in an easily digestible visual format. You might see a pie chart showing what percentage of your income goes toward housing, transportation, or entertainment. You can view bar graphs that track your spending in a specific category over several months. This is more than just pretty charts, it's about pattern recognition. The AI can identify trends you might not have noticed on your own. For example, it might highlight that your subscription service costs have crept up over the past year, or that your grocery bills are consistently higher in the last week of the month. It can identify and list all your recurring payments, allowing you to see exactly where your money is going on a regular basis. You might discover a subscription for a service you forgot you were even paying for. The goal here isn't to make you feel good or bad about your spending. It is to provide a clear, objective, and accurate mirror of your financial behavior. It gives you the what, so you can decide on the why. Perhaps the most significant leap forward is how AI enables predictive budgeting and forecasting. Traditional budgeting was about looking back. AI allows you to look forward. By analyzing your past income and spending habits, these systems can help you create a realistic and sustainable budget. Instead of you picking arbitrary numbers for spending limits, the AI can suggest a starting point based on your actual, historical data. Furthermore, AI can use this data to forecast your financial future. It can identify your regular paychecks and your recurring bills, like rent, car payments, and utility bills. By combining this information with your typical daily spending patterns, it can project your account balances into the future. This leads to one of the most helpful features, predictive alerts. You might get a notification that says something like, based on your upcoming bills and recent spending, your checking account balance is projected to be low in 10 days. This is not an alarm bell telling you that you've already overdrawn. It's a friendly heads-up that gives you time to adjust. It allows you to make a change, perhaps by delaying a non-essential purchase or transferring money, before a problem even occurs. This shifts financial management from damage control to proactive planning. In summary, AI has taken the core principles of budgeting, tracking, categorizing, and planning, and supercharged them with automation and intelligence. It removes the friction and manual labor, provides clear and unbiased insights into spending habits, and equips users with predictive tools to help them stay ahead of their finances. These tools provide the data and the analysis. The decisions about what to do with that information remain entirely in the hands of the individual. Now that we have a firm grasp on how AI is revolutionizing our understanding of cash flow, we can look at the next logical step. What happens to the money we manage to set aside? In our next chapter, we will explore the exciting world of AI-powered savings and investing, from automated savings tools to the rise of the Robo-Advisor. Hello and welcome back. In our previous chapter, we explored how artificial intelligence is fundamentally changing the way we budget and track our expenses, transforming it from a manual chore into an automated, insightful process. We learned how AI gives us a clear picture of our financial health in real time. Now we'll turn to the next logical question. Once you have a handle on your cash flow, what can be done with the money you set aside? This brings us to the exciting and often complex worlds of saving and investing, two more areas where AI is serving as a powerful co-pilot for many Americans. Let's begin with saving. The classic advice has always been to pay yourself first, but busy lives and fluctuating expenses can make consistent saving a challenge. AI introduces a concept often called intelligent automation into the savings process. Imagine an app that functions like a financial assistant, constantly looking for small, opportune moments to help you save without you having to think about it. Here's how it generally works. Similar to budgeting apps, these AI-powered savings tools securely connect to your primary checking account. The AI then gets to work, analyzing your income and spending patterns. It learns the rhythm of your financial life, when you get paid, when your major bills are due, and what your discretionary spending looks like. Based on this continuous analysis, the AI identifies small amounts of money that it deems safe to save. Money that you likely won't miss from your checking account, and whose absence won't risk an overdraft. It could be a few dollars here, a few dollars there. It then automatically transfers these small sums into a separate savings account. This process is often called microsaving. Some applications also offer a feature that rounds up your purchases to the nearest dollar and saves the difference. That daily coffee that costs $3.50 results in 50 cents being automatically moved into savings. While these amounts are small individually, AI's relentless consistency can help them accumulate significantly over time. The key here is that the AI is doing the heavy lifting of decision-making. It's removing the psychological barrier of deciding how much to save and when. It automates the habit itself, designed to make saving a background process rather than an active, and sometimes stressful, decision. Now let's move from saving to the world of investing. For many, investing has historically felt inaccessible, perceived as a domain for experts with a lot of capital. The rise of AI has led to the creation of a technology that is fundamentally lowering this barrier to entry: the Robo-Advisor. A Robo-Advisor is a digital platform that provides automated, algorithm-driven investment management services. The process typically begins with a simple, interactive questionnaire when a user signs up. The platform will ask a series of questions designed to understand the individual's financial situation. These questions usually cover topics like their financial goals, for instance, saving for retirement in 30 years, or for a down payment on a house in 5 years. They also gauge the person's timeline and their comfort level with risk, often referred to as risk tolerance. Are they comfortable with potential market ups and downs in exchange for the possibility of higher long-term growth? Or do they prefer a more conservative approach? Once the platform has this information, its algorithms get to work. Based on established financial principles, the AI will construct a proposed investment portfolio. This isn't about picking individual hot stocks. Instead, these platforms commonly use a strategy of diversification, spreading investments across a wide range of assets. This is often accomplished using low-cost exchange-traded funds, or ETFs, which might represent hundreds or even thousands of different stocks or bonds in a single fund. The goal of this diversification is to manage risk. The idea is that if one segment of the market performs poorly, other segments may perform well, helping to balance the overall portfolio. But the AI's job doesn't stop after the initial portfolio is created. Markets are constantly changing, and over time, a portfolio can drift away from its intended allocation. For example, if the stock portion of a portfolio performs very well, it might grow to represent a larger percentage of the total portfolio than originally planned, potentially exposing the investor to more risk than they are comfortable with. This is where AI performs a crucial function called automated rebalancing. The Robo-Advisor system monitors the portfolio continuously. When it drifts too far from its target, the AI will automatically trigger trades, selling a small portion of the assets that have grown and buying more of the assets that have shrunk, to bring the portfolio back into its desired alignment. This disciplined, automated process removes emotion from the equation and ensures the investment strategy stays on track. Some more advanced robo-advisors offer an even more sophisticated, AI-driven feature often referred to as tax loss harvesting. This is a strategy that is simple in concept, but can be very complex to execute manually. In a taxable investment account, when an investment is sold at a loss, that loss can sometimes be used to offset capital gains from other investments that were sold for a profit, potentially reducing the investor's overall tax liability. The AI scans the portfolio for opportunities to sell an investment that has temporarily lost value, harvesting that loss for tax purposes. It will then typically purchase a similar, but not identical, investment to keep the portfolio's overall composition and risk level consistent. AI can perform this complex monitoring and execution across thousands of accounts simultaneously, a task that would be incredibly labor-intensive for a human advisor. In essence, technologies like robo-advisors are making a certain level of sophisticated portfolio management accessible, automated, and available at a lower cost than many traditional alternatives. They operate based on the data and preferences provided by the user, executing a predefined strategy with speed and discipline. In our next chapter, we will shift our focus from assets to liabilities. We'll examine how AI is reshaping the world of credit and lending, from how credit scores are determined to the way individuals apply for and manage loans. Hello and welcome back to our ongoing exploration of artificial intelligence in personal finance. We've journeyed through the worlds of budgeting, saving, and investing, seeing how AI can provide tools for managing our assets. Today, we turn our attention to the other side of the balance sheet, liabilities. We're diving into the critical areas of credit and lending, a part of the financial system that impacts nearly every American adult, influencing everything from renting an apartment to buying a car or a home. For decades, the gateway to these life goals has been the traditional credit score. This three-digit number, generated by models like FICO and VantageScore, has served as the primary measure of a person's financial trustworthiness. These scores are calculated based on a relatively narrow set of data points found in your credit reports. Your history of paying back loans, how much of your available credit you're using, the length of your credit history, and so on. While this system has been the standard for a long time, it has limitations. It can often be a challenge for younger individuals, recent immigrants, or anyone who has a limited credit history, sometimes referred to as being credit invisible. If you don't have a track record within this specific system, proving your creditworthiness can be difficult. This is where artificial intelligence is beginning to write a new chapter. Lenders are increasingly exploring AI models that can look beyond the traditional credit report to build a more comprehensive, holistic, and dynamic picture of an individual's financial life. The key to this is the use of what is known as alternative data. This isn't mysterious information. It's simply financial data that hasn't typically been factored into credit scoring. Think about it. You may have a long and perfect history of paying your rent on time, every single month. You may have a flawless record of paying your utility and cell phone bills. Your checking account may show a stable income and a positive cash flow. Traditionally, none of this positive financial behavior would directly contribute to your credit score. AI-powered models, however, are designed to analyze these very data points. With a consumer's consent, These systems can analyze bank account transactions to verify income and observe cash flow patterns. They can incorporate on-time rent and utility payments into their calculations. The machine learning algorithms search for patterns of financial responsibility wherever they can be found. The potential here is a significant expansion of financial inclusion. By looking at a broader set of data, these AI models may allow individuals who are perfectly responsible but have a thin credit file to gain access to credit products, sometimes on more favorable terms than would otherwise be possible. It's a shift from looking only at your history of repaying debt to looking at your overall history of managing financial obligations. Beyond the score itself, AI is also dramatically accelerating the entire lending process. Anyone who has applied for a major loan, like a mortgage, knows the traditional process can be slow and paper-intensive. It often involves gathering piles of documents, pay stubs, tax returns, bank statements, and more. You submit them, and then you wait, sometimes for days or even weeks, while a human underwriter manually reviews everything. AI is streamlining this from start to finish. In today's digital world, many application processes can, with your explicit permission, use secure connections called APIs to instantly verify your income and employment directly from the source. For documents that still need to be uploaded, AI technologies like optical character recognition, or OCR, can read and digitize the information from a PDF or a photo in seconds. Natural language processing, or NLP, then helps the system understand the context of that information. The AI can cross-reference all this data almost instantaneously, checking for inconsistencies and flagging potential issues for human review. This high level of automation means that the underwriting process, the core risk analysis performed by the lender, can be completed in a fraction of the time. For consumers, this translates to faster decisions, often moving from a multi-day waiting game to a response in mere minutes. Finally, AI is also emerging as a powerful tool for managing existing debt. AI-powered financial apps can provide a clear dashboard of all your liabilities, credit cards, student loans, auto loans, in one place. More than just listing them, these tools can run simulations. For example, a user could compare different debt repayment strategies. The system could show them a projection of how long it would take to become debt-free, and how much total interest they would pay if they used the snowball method versus the avalanche method. The AI doesn't tell the user what to do. It simply models the potential outcomes of different choices, empowering the individual with data to inform their own strategy. Now, it is essential to approach this technological shift with a balanced perspective. The use of AI in credit and lending also raises important questions that technologists, regulators, and consumer advocates are actively discussing. One of the most critical topics is algorithmic bias. If the historical data used to train an AI model contains reflections of past human biases, the AI might inadvertently learn and even amplify those biases in its decision-making. Another challenge is the black box problem, where some highly complex AI models can make it difficult to understand the specific reasons behind a particular decision. Ensuring that these systems are fair, transparent, and explainable is a crucial goal to ensure that the technology serves everyone equitably. In conclusion, AI is acting as a powerful catalyst in the world of credit, offering the potential for a more inclusive and efficient system. It is changing how creditworthiness is assessed and how lending decisions are made. In our next chapter, we will investigate how this same data analysis power is used to protect you, as we explore the world of AI and fraud detection and financial security. Hello and welcome back. In our last chapter, we explored the expanding digital footprint we create when we apply for credit and loans. This vast web of interconnected financial data brings incredible convenience, but it also opens up new avenues for fraud and security threats. So, how is the financial industry protecting our sensitive information in this fast-paced digital world? The answer, increasingly, is artificial intelligence. Today, we're going to look at how AI acts as a silent, sleepless digital guardian, working 24/7 behind the scenes to protect our financial lives. One of the earliest and most successful applications of AI in the financial sector has been in fraud detection. In the past, security systems relied on a rigid set of rules. For example, a rule might be to block any credit card transaction over $1,000 that originates from a foreign country. While simple, this approach was clumsy. It often resulted in legitimate transactions being denied, like when you're on vacation. And it could be easily outsmarted by criminals who understood the rules. AI has replaced this static, rule-based system with a dynamic, learning-based approach centered on you. The core of modern AI security is something called behavioral profiling. Essentially, the AI system's first job is to get to know you, financially speaking. By analyzing thousands of data points, it builds a unique and constantly evolving profile of your normal financial behavior. This profile includes a multitude of variables: the types of stores you frequent, the average amount you spend per transaction, the time of day you're usually active, the geographic locations you typically make purchases from, and even the specific devices you use to access your accounts. This creates a detailed and personalized financial fingerprint that is unique to you. Once this baseline of normal behavior is established, the AI's primary task is to watch for anomalies, things that don't fit your pattern. This is where machine learning shines. The system isn't looking for a specific, pre-programmed fraudulent activity. It's looking for any significant deviation from your norm. For example, imagine you live and work in Ohio and use your card for everyday purchases like gas and groceries. Suddenly, a $2,000 charge for luxury electronics appears from a city you've never been to. The AI immediately recognizes this as a major anomaly. It doesn't match your spending habits, your location, or your typical purchase categories. In a fraction of a second, the AI calculates a risk score for the transaction. This isn't a simple yes or no decision. A transaction with a low risk score might go through without any issue. A transaction with a moderate risk score, say an online purchase from a new store that's slightly larger than usual, might trigger an immediate text message or app notification to your phone, asking you to verify the purchase with a simple yes or no. A transaction with a very high risk score, like the one in our example, might be blocked outright, and you would receive a more urgent fraud alert. This ability to assess risk in real time and tailor the response is what makes AI so effective. It reduces the number of false positives, where legitimate transactions are inconveniently declined, while being highly effective at stopping actual fraud before it can cause significant damage. But AI's role as a digital guardian extends far beyond monitoring transactions. It is also revolutionizing how we prove our identity in the first place, a process known as authentication. Passwords, as we all know, can be stolen, forgotten, or cracked. AI is powering the shift toward more secure methods using biometrics, something you are, rather than something you know. When you use your face to unlock your banking app, you're using a sophisticated AI. The system's neural network has learned to identify the unique mathematical patterns of your facial features, the distance between your eyes, the shape of your nose, and can distinguish you from anyone else, even in different lighting conditions or at different angles. Similarly, AI-powered fingerprint scanners and even voice recognition systems used by bank call centers create a unique biometric signature. These systems can detect subtle differences that a human might miss, making it incredibly difficult for an imposter to gain access to your accounts. Furthermore, AI is a key player in the fight against phishing scams. These are the fraudulent emails or text messages designed to trick you into revealing personal information. AI systems at email providers and financial institutions analyze millions of messages, learning to recognize the telltale signs of a scam. They can identify suspicious links, analyze the language for a sense of false urgency, and check the sender's reputation, automatically filtering these dangerous messages out of your inbox or flagging them with a warning. In summary, the role of AI in financial security is a profound shift from a reactive to a proactive and even predictive posture. Instead of just responding to fraud after it happens, AI systems work to prevent it by understanding your unique behavior, identifying threats in real time, and securing your identity with advanced technologies. It's a continuous, adaptive, and personalized layer of protection for our digital financial lives. In our next chapter, we will move from the background processes of AI to its more visible, interactive roles. We'll explore how AI is changing financial customer service through intelligent chatbots and personalized digital experiences. Hello and welcome back. In our last chapter, we pulled back the curtain on the invisible work of AI, exploring its role as a digital guardian protecting us from fraud. Today, we move from the background to the foreground. We're going to examine how AI is becoming the new visible front door for many financial institutions, changing the very nature of how we interact with them. This is the world of AI-driven customer service and personalization. For decades, customer service in banking meant one of two things: driving to a physical branch during business hours or calling a toll-free number and potentially waiting on hold. While effective, this model was limited by time and human availability. AI is breaking down these barriers, creating a customer service environment that is immediate, always on, and increasingly intelligent. The most common and recognizable form of this technology is the financial chatbot, or virtual assistant. Many of us have already interacted with one, perhaps by typing a question into a chat window on a bank's website or app.
Disclaimer: The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
But these are not the simple, rigid bots of the past that could only respond to a few specific keywords. Today's conversational AI is powered by a sophisticated technology called natural language processing, or NLP. In simple terms, NLP is what allows a computer to understand, interpret, and respond in natural human language, the way you actually talk or type. This technology unlocks a whole new level of self-service. A user can now ask complex, conversational questions like, "How much did I spend on groceries last month?" Or, "What was my checking account balance before my last paycheck?" The AI can understand the intent behind these questions, retrieve the precise information from the user's account data, and provide a clear, concise answer in seconds. Beyond just answering questions, these virtual assistants can often perform tasks. A user might say, "Transfer $50 from my savings to my checking," or "Show me my most recent credit card statement." The AI can execute these commands directly, turning a simple chat interface into a powerful control panel for your finances. The primary goal of this technology is to provide instant solutions for a wide range of common queries and tasks. This creates a more efficient experience for the customer, who gets an immediate answer without waiting for a human agent. It also allows human customer service representatives to focus their time and expertise on more complex, nuanced, or sensitive issues that require a human touch, like discussing a major financial decision or resolving a complicated account problem. Building on this conversational ability, AI is also enabling a new era of personalization. Historically, your banking experience was largely generic. Everyone saw the same app interface, the same product offers, and the same website. AI allows financial institutions to tailor the digital experience to the individual. By analyzing the same secure account data we discussed in our chapter on budgeting, AI can identify patterns and present information that is uniquely relevant to you. It's important to clarify what this means. This is not about an AI making financial decisions for you. Rather, it's about the system surfacing relevant information and insights. For example, the AI might generate a personalized insight that appears on your app's home screen, such as, "You've spent 20% less on dining out this month compared to your average," or, "A large annual subscription payment is scheduled to be withdrawn next week." These are data-driven observations designed to increase your financial awareness. This personalization can also extend to the financial products and educational content you see. If a person's transaction history shows frequent foreign travel, the bank's AI system might display a banner with information about its credit cards that have no foreign transaction fees. The system isn't advising the person to apply for the card. It is simply making them aware of a potentially relevant product based on their observable behavior. This is a subtle but important distinction. It's a shift from generic advertising to personalized information delivery. Similarly, the system might highlight educational articles or videos relevant to a user's financial life stage. A user who has just taken out a student loan might see content about repayment options, while someone nearing retirement might be shown articles about income distribution strategies. This creates a more dynamic and responsive banking experience. The ultimate goal for many institutions is to create a seamless partnership between AI and human experts. In many systems, if a user's query is too complex for the chatbot to handle, the AI can perform a warm handoff to a human agent. It can transfer the user, along with the entire transcript of their conversation so far, directly to a person. This means the customer doesn't have to start over and repeat all the information, leading to a faster and less frustrating resolution. In summary, AI is transforming the front end of finance by making it more conversational, accessible, and personalized. It's providing tools for instant answers and actions, and it's tailoring the digital experience to the individual's needs and behaviors, all while keeping the user firmly in control of their own financial decisions. In our next chapter, we will take a step back to look at the bigger picture, exploring how AI is not just changing personal finance, but the entire financial industry, from stock market analysis to the future of financial careers. Hello and welcome back. Over the past 6 chapters, we have focused our lens on the individual, exploring how artificial intelligence is transforming the tools we use for budgeting, saving, investing, and security. Now we're going to zoom out. We'll lift our gaze from our personal bank accounts to the towering skyscrapers of the financial world. In this chapter, we'll explore the bigger picture: how the very same AI technologies are revolutionizing the foundational pillars of the entire financial industry, from the high-stakes trading floors of Wall Street to the evolving nature of a career in finance itself. Let's start with the world of institutional investing and market analysis. For decades, financial analysis has been a human-driven process of reading reports, building complex spreadsheets, and making informed judgments. While human expertise remains critical, AI is introducing a level of speed and scale that was previously unimaginable. The modern financial world is flooded with data, not just traditional stock prices and corporate earnings reports, but a torrent of alternative data from satellite imagery, shipping manifests, social media trends, and millions of news articles published every day around the globe. No human or team of humans could possibly process all of this information, but AI can. Large financial institutions now use sophisticated machine learning models for what is known as quantitative analysis. For example, an AI powered by natural language processing can scan thousands of news articles and social media posts in seconds to gauge market sentiment. It can measure whether the overall tone of conversation about a particular company or industry is becoming more positive or negative, providing a real-time pulse on public perception. Other AI models are designed for advanced pattern recognition. They sift through decades of historical market data to identify complex, non-obvious correlations between different assets and economic indicators. This isn't about simply predicting the future. It's about identifying statistical probabilities and potential risks that might be invisible to the human eye. This analysis then informs high-frequency trading algorithms that can execute millions of trades in fractions of a second, capitalizing on tiny market fluctuations. The core advantage AI provides here is not magic, but mathematics and speed on a massive scale. While these high-speed applications are reshaping trading, another, less visible AI revolution is happening in the back offices. This is the world of risk management and regulatory compliance. The financial industry is one of the most heavily regulated sectors in the world, and staying compliant is a monumental task. This has given rise to a new field called RegTech, or regulatory technology, where AI is a key player. Financial institutions must adhere to a constantly changing landscape of thousands of rules and regulations. AI systems using NLP can read and interpret new regulatory documents as they are released, helping compliance departments quickly understand their new obligations. Even more critically, AI is a powerful tool in the fight against financial crime. Banks are required to monitor all transactions for signs of money laundering or other illicit activities. In the past, this was done with rule-based systems that produced a high number of false positives, flagging legitimate transactions and creating a massive workload for human investigators. Modern AI systems, however, learn the patterns of normal versus suspicious behavior. This allows them to identify potentially criminal activity with much greater accuracy, reducing false alarms and allowing investigators to focus on the most credible threats. AI also plays a major role in proactive risk management. Institutions can use AI to run massive simulations or stress tests on their investment portfolios. These models can simulate thousands of potential economic scenarios: a sudden rise in interest rates, a global supply chain disruption, a housing market downturn, to see how their assets would perform. This allows risk managers to identify hidden vulnerabilities in their portfolios before a crisis actually occurs. With all this technological change, a natural question arises: what does this mean for the people who work in finance? The rise of AI has led to many discussions about the future of financial careers. The prevailing view among industry experts is that AI is a tool for augmentation, not outright replacement. It is automating many of the routine, repetitive tasks that once consumed a large portion of a financial professional's day. Tasks like manual data entry, basic report generation, and information gathering are increasingly being handled by AI. This shift doesn't eliminate the need for human experts. It changes their role. It frees up professionals to focus on higher value work that machines cannot do. This includes strategic thinking, complex problem solving, building client relationships, and exercising ethical judgment. The financial analyst of the future may spend less time in spreadsheets and more time interpreting the insights generated by AI systems, explaining those insights to clients, and crafting creative financial strategies. The skills in demand are evolving. Data literacy, critical thinking, and adaptability are becoming just as important as traditional financial acumen. The human element, it seems, is becoming more valuable, not less. In our next chapter, we will turn our focus to the future, looking at the emerging trends and ethical considerations of AI in finance. And we'll imagine what our financial lives might look like in the decade to come. Hello and welcome back. Throughout this series, we have journeyed from the present-day applications of artificial intelligence in our own financial lives to its transformative impact on the global financial industry. We've seen how AI is already here, working as our budget manager, security guard, and customer service agent. In this chapter, we cast our eyes forward, to the road ahead. We'll explore the emerging trends that could define the next decade of financial AI. And we'll also address the critical ethical questions that we, as a society, must consider as these powerful tools become even more integrated into our lives. One of the most significant trends on the horizon is the move toward what some are calling hyperpersonalization. We've already discussed how AI can personalize the information we see. The next evolution is a system that doesn't just present information, but helps to seamlessly integrate your financial decisions. Imagine a future where your financial apps don't just track your budget, but can intelligently communicate with each other. Your budgeting app might note a surplus of funds and, based on goals you've pre-established, could ask if you'd like to allocate that surplus toward paying down a high-interest credit card, adding to your investment portfolio, or moving it into a high-yield savings account. The system makes the suggestion. The final decision is always yours, but the friction of taking action is significantly reduced. Another frontier is the rise of generative AI, the same technology that powers advanced chatbots and creative tools. In the future, this could be used to create highly sophisticated financial simulations. Instead of just seeing a graph of your potential retirement savings, you could interact with an AI to explore different life scenarios. You might ask, show me the potential impact on my long-term financial goals if I decide to take a 2-year break from work to go back to school. Or model the difference between buying a home now versus waiting 5 years. The AI could then generate a detailed, narrative-based projection, helping you visualize the potential consequences of major life decisions in a way that is intuitive and easy to understand. This is not about predicting the future, but about making potential outcomes more tangible. As we look further out, some technologists envision a concept known as autonomous finance. This is the idea of an AI-powered system that, with your explicit permission and within strict parameters you set, could manage the day-to-day minutiae of your financial life automatically. It could optimize your bill payments to maximize your cash flow, automatically sweep spare cash into the most advantageous savings vehicles, and even rebalance your investments according to your preset strategy. This would represent the ultimate evolution from proactive alerts to automated, optimized execution, designed to act in your best interest based on the rules and goals you've defined. However, as these technologies become more powerful and autonomous, it is absolutely critical that we address the ethical considerations that accompany them. We touched on algorithmic bias in a previous chapter, and this remains a central concern. AI systems learn from data, and if the historical data reflects societal biases, the AI can learn and perpetuate those same biases in credit applications, loan rates, and even product offers. Ensuring fairness and equity in the design and training of these systems is one of the most significant challenges facing the industry. Another major question is that of data privacy and security. For AI to provide hyper-personalized insights, it requires access to a vast amount of your financial data. How is that data being used? Who has access to it? How is it being protected from cyber threats? As consumers, understanding the data privacy policies of the services we use will become increasingly important. There is an ongoing dialogue between consumers, tech companies, and regulators about establishing clear rules for data ownership and responsible usage. Finally, there is the issue of transparency and explainability, often called the black box problem. Some complex AI models can arrive at a conclusion without being able to clearly articulate how they got there. If an AI system denies a loan application or suggests a major financial action, the individual has a right to understand the reasoning behind that outcome. Developing explainable AI, or XAI, is a major field of research, focused on building systems that can show their work, so to speak, ensuring that the logic behind automated decisions is both transparent and accountable. The road ahead for AI in personal finance is undeniably exciting, promising a future that is more personalized, efficient, and accessible. But it is a path that must be navigated with caution and a strong ethical compass. The most powerful tools are those that are not only intelligent but also fair, transparent, and secure. In our next chapter, we will begin to bring these concepts together, offering a practical look at how to navigate this new financial world. Hello and welcome back. In our journey together through the world of financial AI, we have explored what this technology is, how it works behind the scenes, and the future it promises. We've moved from theory to application, and from the present to the future. In this chapter, we bring it all home. The goal today is to provide a practical framework, a set of guiding principles and questions, to help you navigate the growing ecosystem of AI-powered financial tools confidently and responsibly. Before we begin, it is essential to restate the purpose of this framework. This is an educational guide designed to help you think critically about financial technology. It is not, and should not be interpreted as financial advice. The objective is to empower you with a method for evaluating tools, so you can determine for yourself what might be appropriate for your own personal financial journey. The first and most important step in this framework is to start with your why. Before you ever type a search into an app store, the most productive thing you can do is clarify your own goals. In a world with a dizzying array of options, technology can sometimes feel like a solution in search of a problem. By defining your own specific objectives first, you can filter out the noise and focus on what truly matters to you. Take some time to consider what you want to achieve. Is your primary goal to gain clarity on your spending? If so, you might be interested in tools that specialize in automated expense tracking and categorization. Is your main challenge consistency in saving? In that case, applications focused on automated or micro-saving features could be more relevant. Perhaps your goal is efficiency, simplifying your bill payment process, and ensuring you never miss a due date. Or maybe your objective is education, and you're looking for a structured way to learn about concepts like investing. By clearly defining your why, you can assess any tool based on a simple question. Does this service directly help me achieve my specific, predefined goal? Once you have a clear goal in mind, the second step is to do your own research by evaluating the what and the how of any tool you consider. This involves looking past the marketing and understanding the core functionality. Read the feature list on the company's website or in the app description. Does it align with the goal you identified in step 1? It's easy to be drawn in by a long list of features, but many of them may be irrelevant to your needs. Next, consider the cost structure. Many financial apps operate on different models. Some are free but may be supported by advertising. Others use a freemium model, where basic features are free, but advanced capabilities require a paid subscription. Others charge a flat monthly or annual fee. There is no single best model. The key is to assess the value proposition. Ask yourself if the service provided, whether it's time saved, insights gained, or the automation of a difficult habit, is worth the monetary cost, if any. Also, consider the user experience. A tool designed to bring financial clarity shouldn't be confusing to use. Look at screenshots, watch demo videos if they are available, and read reviews from other users. An intuitive, well-designed interface can make all the difference in whether you stick with a new tool long-term. The third step in our framework is one that is absolutely non-negotiable: prioritizing security and privacy. When you use a financial app, you are entrusting it with some of your most sensitive information. It is crucial to understand how that trust is being honored. Reputable financial technology companies are typically very transparent about their security practices. Look for a security or trust page on their website. They will often describe the measures they take, such as using bank-level encryption to protect your data, and offering multi-factor authentication to secure your account. Equally important is the privacy policy. While these documents can be long and dense, many companies now provide summaries or frequently asked questions that highlight the most important points. The key questions to ask are: what data is this app collecting? How is it using my data? And is it sharing my data with any third parties? Understanding the answers to these questions allows you to make an informed decision about your comfort level with the service's data practices. Many modern apps also use secure, third-party services to link to your bank accounts, which means you don't have to provide your direct bank login credentials to the app itself, adding an important layer of security. In conclusion, this three-step framework, defining your goals, researching the tool's function and value, and prioritizing security, can serve as a reliable guide in the new financial landscape. These AI-powered services are best viewed as powerful tools, like a sophisticated calculator or an automated ledger. They can provide data, insights, and efficiency at a level never before possible. But a tool is only as effective as the person using it. They do not replace the need for your own judgment, your ongoing financial education, and when appropriate, consultation with a qualified human professional. You are still the architect of your financial life. AI is simply one of the new, powerful tools in your toolkit. In our next chapter, we will delve into the relationship between AI and the crucial skill of financial literacy. Hello and welcome back. In our last chapter, we established a practical framework for navigating the world of financial technology, emphasizing that AI is a powerful instrument in our personal finance toolkit. But perhaps the most profound impact of a great tool isn't just what it does for us, but what it teaches us. Today, we delve into one of the most promising applications of this technology: AI's role as an interactive tutor, working to boost the crucial skill of financial literacy. Financial literacy, the knowledge and ability to make informed and effective decisions with your financial resources, is the bedrock of financial well-being. For decades, however, financial education has often been delivered in a one-size-fits-all format. It might be a generic article online, a brochure at a bank, or a formal classroom lecture. While well-intentioned, this approach often fails to connect with individuals at their specific level of understanding or address their unique financial situation. Artificial intelligence is fundamentally changing this paradigm by making financial education deeply personal. Imagine a learning experience that adapts to you. Many emerging financial wellness platforms use AI to create personalized learning paths. When a user first engages with such a system, they might be prompted with a short, simple quiz to gauge their current understanding of various financial topics. Based on the results, the AI tailors the educational content. A person who is new to managing their own finances might be presented with interactive modules on the fundamentals of budgeting and building an emergency fund. In contrast, a user who demonstrates a solid grasp of the basics might be shown content that explains the differences between various investment or retirement accounts. This personalization also extends to the timing of the education. AI can provide just-in-time learning, which is often the most effective kind. For instance, when you're looking at your mortgage statement within your banking app, you might see a small, clickable icon next to the term escrow. Tapping it could launch a short, animated video or a simple text explanation, generated by an AI, that clearly explains what an escrow account is and why it's part of your payment. This contextual learning, getting the right information at the exact moment you need it, is incredibly powerful for building real-world understanding. One of the biggest barriers to financial literacy has always been jargon. The world of finance is filled with complex terms and acronyms that can feel intimidating. AI, particularly conversational AI, is acting as a powerful jargon translator. Modern financial chatbots and virtual assistants can function as a patient, 24/7 tutor. You can ask a direct question in plain English, such as, "Can you explain what diversification means?" Or "What's the difference between a traditional and a Roth IRA?" and receive an immediate, clear, and simple explanation. There's no fear of asking a dumb question. Furthermore, AI can transform abstract financial concepts into tangible, interactive experiences. Take the idea of compound interest. A static definition in a textbook can be hard to grasp. An AI-powered tool, however, can create a personalized, visual simulation. It might allow a user to input a hypothetical savings amount, interest rate, and time frame, and then watch a dynamic graph that shows the potential growth, visually demonstrating how compounding works year after year. This interactive approach helps to build a much deeper and more intuitive understanding than passive reading alone. Finally, AI is making the process of learning about finance more engaging through a concept called gamification. This involves applying game-like elements, such as points, badges, and challenges, to non-game activities. Financial wellness apps are using this to encourage positive habits. You might earn points for consistently staying within your budget for a week, or unlock a new badge for completing an educational module on credit scores. The AI can personalize these challenges, setting small, achievable goals based on your past behavior. This creates a positive feedback loop that makes engaging with your finances feel less like a chore and more like a rewarding journey. Some platforms even offer risk-free simulations, like a virtual stock market game, where users can practice making investment decisions with play money, learning how markets behave without any real-world financial consequences. In conclusion, AI is not just automating financial tasks, it's democratizing financial knowledge. By acting as a personalized tutor, a jargon translator, and an engaging coach, it is breaking down long-standing barriers to financial literacy. While these tools provide the information and the learning platform, their ultimate goal is to build a user's own knowledge and confidence. Because in the end, a strong foundation of financial literacy is the most important asset anyone can have, enabling them to use any financial tool, AI-powered or not, wisely and effectively. In our next chapter, we will explore the evolving relationship between AI and human financial advisors, a partnership that is shaping the future of financial guidance. Hello and welcome back. In our last chapter, We explored how artificial intelligence is serving as a personalized tutor, working to enhance our own financial literacy and empower us with knowledge. This raises a fascinating and important question. If AI can help us learn about finance, track our budgets, and even automate our investments, what does this mean for the future of the human financial advisor? The common narrative often pits technology against people, but in the world of finance, a different, more collaborative story is unfolding. The future isn't about AI versus the human advisor. It's about AI and the human advisor, working together in a powerful hybrid model. Let's first look at the role AI is playing within an advisory practice. Think of AI as the ultimate analyst and assistant. One of the most time-consuming aspects of financial planning has always been data collection. A human advisor needs a complete picture of a client's financial life, which historically meant gathering statements and manually entering data from dozens of different accounts. Today, AI-powered aggregation tools can, with a client's permission, securely and automatically pull all of this information together into a single, comprehensive dashboard. This gives the advisor an instant, up-to-date view of the client's entire financial world, freeing up hours of administrative work. Beyond data gathering, AI excels at complex modeling and simulation. A client might ask their advisor, "What would be the potential impact on my retirement plan if I decided to purchase a vacation home in 10 years? Or can I afford to retire 2 years earlier than planned?" In the past, answering these questions required hours of complex spreadsheet calculations. Now, an advisor can use AI-powered software to run thousands of what-if scenarios in seconds. The AI models the potential outcomes based on different market conditions and spending assumptions, providing the advisor with data-driven projections to share with the client. AI also acts as a tireless, watchful eye. It can monitor a client's investment portfolio in real time, continuously checking its alignment against the client's long-term goals and stated risk tolerance. If market movements cause the portfolio to drift, the AI can alert the advisor that it may be time for a rebalancing. This automates a crucial but repetitive task, allowing the advisor to manage their client's strategies more efficiently and proactively. With AI handling these data-intensive analytical and administrative tasks, what is left for the human advisor? As it turns out, the most important work of all. The role of the advisor is shifting away from being a data cruncher and toward being a strategist, a coach, and a counselor. While AI can analyze the numbers, it cannot understand the human story behind them. A human advisor's primary job is to understand a client's values, their fears, their dreams for their family, and their definition of a meaningful life. These are the whys that give the financial plan its purpose. This is especially critical when it comes to behavioral coaching. One of the greatest challenges in long-term financial planning is managing human emotion. It is natural to feel fear during a market downturn or greed during a period of rapid growth. An AI can provide data showing that, historically, markets recover, but it cannot provide the empathy and reassurance needed to help a client navigate their anxiety and stick to their plan. A human advisor provides that steady hand, acting as a crucial barrier between a client's emotions and potentially short-sighted financial decisions. Furthermore, human advisors excel at complex, holistic strategy. A person's financial life is not just a collection of accounts. It's an interconnected web of investments, insurance, tax considerations, estate planning, and family dynamics. A skilled advisor can weave all of these disparate threads together into a single, cohesive strategy, a task that requires a level of creative problem-solving and nuanced judgment that is currently far beyond the scope of AI. This synergy between machine intelligence and human wisdom is what defines the hybrid model of financial guidance. The AI provides the speed, scale, and analytical power, processing vast amounts of information to deliver data-driven insights. The human advisor provides the empathy, the strategic oversight, and the trusted relationship. This partnership is not only leading to more robust and personalized financial plans, but it's also making professional advice more efficient. By automating many back-office tasks, advisors can potentially serve a broader range of clients more effectively. In conclusion, AI is not replacing the human financial advisor. It is augmenting and empowering them. The technology is allowing professionals to be more of what their clients need them to be: a guide, a strategist, and a trusted partner. The AI can handle the what, the data and the calculations, so the human can focus entirely on the why.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, You agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The client's unique life and goals. In our next chapter, we will focus on one of the most significant financial goals for many Americans, planning for retirement, and explore how AI is shaping that landscape. Hello and welcome back. In our last chapter, we examined the powerful synergy between artificial intelligence and human financial advisors. Today, we're going to focus that lens on what is, for many Americans, the single largest and longest-term financial goal of their lives: planning for retirement. For decades, the primary tool for the average person was the simple online retirement calculator. You'd input your age, your income, your current savings, and it would provide a single number. While a helpful starting point, this approach was based on broad averages and static assumptions. AI is now transforming retirement planning, moving it from simple arithmetic to sophisticated, personalized simulation. The fundamental difference in the AI-powered approach is its ability to create a dynamic and deeply personalized financial model. Instead of relying on you to guess what your expenses in retirement might be, these systems can, with your permission, analyze your actual current spending habits. The AI learns your financial DNA, how much you spend on housing, food, travel, and healthcare, to create a much more realistic baseline for your future needs. It moves beyond generic assumptions and starts with the reality of your life. Building on this personal foundation, the most powerful function of AI in retirement planning is its ability to model uncertainty. The future is not a single, predictable line. It is a vast range of possibilities. To account for this, advanced AI planning tools often use a methodology known as a Monte Carlo simulation. This may sound complex, but the concept is straightforward. The AI runs thousands, or even tens of thousands, of different retirement scenarios for you. In each simulation, it uses slightly different variables for factors like annual investment returns, inflation rates, and even your potential lifespan. The result of this massive simulation is not a single, misleadingly precise number. Instead, it's a statistical probability. The output might be something like, based on 10,000 simulations, your current plan has a 90% probability of success, meaning you would not run out of money in 9 out of 10 of the potential futures modeled. This probabilistic approach provides a much more realistic and nuanced understanding of your financial situation. It helps to quantify confidence and identify potential risks, moving the conversation from, "Will I have enough?" to "How confident can I be in my plan?" Perhaps the most critical advancement is AI's ability to model the biggest and most unpredictable variables in retirement. Topping that list for many is healthcare. Healthcare costs are not uniform. They vary dramatically by location, and they tend to rise at a faster rate than general inflation. AI models can incorporate these specific variables. They can project future healthcare and potential long-term care costs with greater accuracy by factoring in your geography, your current age, and data-driven trends in medical expenses, providing a more realistic estimate than a simple national average. Another complex variable is the decision of when to begin receiving Social Security benefits. The rules are complex, and the best time to claim can depend on many personal factors. AI-powered tools can illustrate the long-term financial impact of this choice with incredible clarity. A system can model and visually compare the total projected lifetime benefits if you were to start at age 62, at your full retirement age, or at age 70. The tool does not provide advice on which to choose. Instead, it illuminates the trade-offs of each scenario based on the Social Security Administration's formulas and your life expectancy data, allowing you and your advisor to have a much more informed discussion. Beyond just projecting the future, these tools can also provide valuable insights on the present. An AI can analyze your current saving and spending patterns and show you how they align with the assumptions in your long-term plan. It might generate an observation like, "Your current savings rate is 5% higher than the rate projected in your plan," or "Spending in your travel category is trending higher than the amount allocated in your retirement projection." This creates an objective feedback loop, connecting your day-to-day financial decisions with your ultimate long-term goals. In conclusion, AI is bringing a new level of focus and clarity to the complex challenge of retirement planning. By creating personalized, dynamic, and probabilistic forecasts, it is helping individuals better understand the potential trajectory of their financial future. These tools are powerful simulators, designed to model possibilities and illuminate the impact of key decisions. They empower people to ask better questions, and in partnership with financial professionals, to build more resilient and data-driven strategies for one of the most important chapters of their lives. In our next chapter, we will look at another major financial milestone, and explore how AI is influencing the world of real estate and homeownership. Hello and welcome back. In our last chapter, we focused on the long-term goal of retirement planning and the sophisticated tools AI provides for that journey. Today, we turn our attention to another of life's most significant financial milestones: homeownership. The process of buying a home has traditionally been complex, time-consuming, and often stressful. From searching for the right property to securing a mortgage, it's a path filled with paperwork and uncertainty. Now, artificial intelligence is being deployed at every step of this journey, working to make it more efficient, transparent, and personalized. The transformation begins with the very first step: the property search. Not long ago, house hunting involved circling ads in the local newspaper or using basic online filters for zip code and the number of bedrooms. This often resulted in sifting through hundreds of listings that didn't truly fit your needs. AI is making this discovery process dramatically smarter. Modern real estate platforms use machine learning algorithms that learn your preferences as you browse. The system analyzes your behavior, which listings you click on, which photos you spend the most time viewing, and the features of the homes you save to your favorites. By understanding your patterns, the AI moves beyond simple filters to grasp your aesthetic and lifestyle preferences. It might learn that you consistently favor homes with open floor plans, lots of natural light, or large backyards, even if you never explicitly searched for those terms. As a result, the platform begins to proactively recommend properties that are a much better match for your tastes, saving you countless hours and making the search far less overwhelming. Furthermore, AI is revolutionizing how we view properties before ever stepping inside. Immersive 3D and virtual reality tours, powered by AI, allow you to digitally walk through a home from your own living room. These are not just slideshows of photos. They are detailed, interactive digital models of the space. This technology makes it possible to tour dozens of potential homes in a single afternoon, helping you to efficiently create a shortlist of your top contenders for in-person visits. Once you've found a property you love, the next question is about its value. This brings us to another powerful AI application: the Automated Valuation Model, or AVM. An AVM is a system that uses machine learning to estimate a property's market value in seconds. It does this by analyzing a massive and diverse range of data, including recent sales prices of comparable homes in the area, property characteristics, tax records, school district ratings, and local market trends. While a traditional human appraisal remains a crucial part of the formal transaction, an AVM provides an instant, data-driven starting point for both buyers and sellers, offering valuable context about a home's potential price. With a property selected, the final major hurdle is financing, and the traditionally paper-intensive mortgage process is also being streamlined by AI. Lenders are using AI to accelerate nearly every stage of the application. When you submit documents like pay stubs and bank statements, AI with optical character recognition, or OCR, can read and extract the necessary information automatically, eliminating hours of manual data entry for loan officers. AI models also enhance the underwriting process, where the lender assesses risk. As we discussed in a previous chapter, these systems can analyze a borrower's complete financial profile to make a faster and more holistic assessment. Throughout the process, AI-powered chatbots can provide 24/7 assistance, answering common questions from borrowers about their loan status or required documentation, improving communication and transparency. The cumulative effect of this automation is a mortgage process that is significantly faster and less stressful for the homebuyer. In conclusion, AI is serving as a powerful co-pilot on the journey to homeownership. It's creating a more personalized and efficient property search, providing instant data-driven valuation insights, and dramatically accelerating the financing process. These tools are designed to provide information and efficiency, empowering you to navigate one of life's biggest decisions with more clarity and confidence than ever before. In our next chapter, we will explore how AI is impacting another essential component of our financial lives: the world of insurance. Hello and welcome back. In our last chapter, we navigated the world of real estate and saw how AI is streamlining the path to homeownership. Now we turn to the essential financial shield designed to protect that home, our vehicles, and our well-being: the world of insurance. For generations, the insurance model has been fundamentally reactive. An unfortunate event would happen: a car accident, a storm, a health issue, and the insurer would process a claim to help cover the cost. Today, artificial intelligence is flipping that model on its head, transforming insurance from a reactive repair and replace system to a proactive and deeply personalized predict and prevent partnership. This transformation starts with the very foundation of insurance: how risk is assessed and how policies are priced. Traditionally, insurers have relied on broad demographic categories to determine premiums. For auto insurance, for example, your rate was largely based on your age, your zip code, your gender, and the type of car you drive. It was a system based on averages. AI is enabling a massive shift away from averages and toward the individual, through what is known as personalized underwriting. The most prominent example of this is usage-based insurance, or UBI, in the automotive sector. Instead of just looking at who you are, these programs use technology called telematics, often through a small device in your car or an app on your smartphone, to understand how you actually drive. The AI analyzes data about your driving habits, your average speed, how frequently you brake hard, the times of day you typically drive, and your total mileage. This real-world behavioral data allows the insurer to create a risk profile that is unique to you, not just to your demographic group. A similar revolution is happening in property insurance. In the past, the risk assessment for a home was based on general factors like its location. Now, AI can perform a highly specific analysis of an individual property. It can analyze high-resolution satellite and aerial imagery to assess the current condition of a roof, identify the proximity of flammable trees in a wildfire-prone area, or even detect if a backyard pool is unfenced. This granular, data-driven approach allows for a much more accurate assessment of a specific property's risk. Perhaps the most visible impact of AI for consumers is the dramatic streamlining of the claims process. Anyone who has had to file a claim knows it can be a slow, uncertain, and often frustrating experience filled with phone calls and paperwork. AI is working to make this process faster and more transparent. For example, in what is often called touchless claims, a policyholder involved in a minor car accident can simply take photos of the damage with their smartphone and upload them to the insurer's app. An AI system using computer vision analyzes these images in seconds. It can identify the damaged parts, cross-reference them with a parts database, and generate a preliminary repair estimate almost instantly. This can turn a process that used to take days or weeks into one that takes mere minutes. Behind the scenes, AI is also a powerful detective. Insurance fraud is a massive problem that costs the industry, and ultimately consumers, billions of dollars each year. AI algorithms can analyze millions of claims to identify subtle, complex patterns that may indicate fraudulent activity, patterns that would be completely invisible to a human adjuster. By flagging suspicious claims with high accuracy, AI helps protect the integrity of the insurance system for everyone. Beyond personalization and efficiency, the most exciting shift is the move toward prevention. Insurers are now using AI to partner with their policyholders to help them avoid losses in the first place. An insurer's AI might analyze weather pattern data and send a targeted alert to a homeowner in the path of a severe hailstorm, suggesting they move their car into a garage. This proactive approach is being amplified by the Internet of Things, or IoT. Smart home devices, like water leak sensors or smart smoke detectors, can provide real-time data. If a sensor detects a small leak under a sink, it can send an alert to both the homeowner's phone and the insurer's AI system. This early warning allows the problem to be fixed before it turns into a catastrophic flood, saving the homeowner immense stress and the insurer a major claim. This transforms the relationship from a simple financial transaction to a collaborative partnership in risk mitigation. As with any technology that uses personal data, these advancements bring important questions. The use of telematics and smart home sensors raises valid concerns about data privacy. Furthermore, it is crucial for the industry and regulators to ensure that the algorithms used for pricing are fair and do not lead to discriminatory outcomes. Addressing these ethical considerations is a key part of the responsible development of financial AI. In our final chapter, we will bring our entire journey to a close, summarizing the key themes we've discovered, and looking one last time at the empowered financial future that AI is helping to shape. Hello, and welcome back for the final chapter of our series on how artificial intelligence is revolutionizing personal finance. Over our journey together, we have explored a vast and rapidly evolving landscape. We began by demystifying AI itself, and then we saw it in action in our daily lives, transforming the way we budget and track our spending. We journeyed through the worlds of automated saving and investing, and navigated the complex processes of credit, retirement planning, and homeownership. We even zoomed out to see AI's impact on the entire financial industry, and took a look at the road ahead. Now, in our concluding chapter, we will bring all these threads together to understand the single, most important story of this technological revolution. The story of the empowered individual. As we look back on everything we've discussed, a few powerful, overarching themes emerge. The first is democratization. For a long time, the most sophisticated financial tools and insights were reserved for large institutions and high-net-worth individuals. AI is breaking down those walls. Technologies like Robo-Advisors are making a certain level of diversified investment management accessible to a much broader audience. Advanced data analysis, once the exclusive domain of quantitative analysts on Wall Street, is now available in the palm of your hand, giving you a clearer picture of your own financial habits. The second major theme is personalization. We are moving away from a one-size-fits-all financial world. Instead of being grouped into broad demographic categories, we are now being treated as individuals with unique financial lives. AI is the engine of this shift. It powers usage-based insurance that reflects how you actually drive, not just your age and zip code. It tailors educational content to your specific level of knowledge and provides insights based on your unique spending and saving patterns. This is a move toward a financial world that understands you. The third, and perhaps most immediate, theme is automation. Throughout this series, we've seen how AI is taking over the routine, repetitive, and often tedious tasks that used to consume our time and energy. From automatically categorizing our expenses to sweeping spare change into a savings account, AI is handling the financial minutiae. This automation doesn't just give us back our time. It frees up our mental energy to focus on what truly matters: our goals, our strategies, and our major life decisions. These themes all culminate in a fourth and final one: a fundamental shift from a reactive to a proactive approach to finance. Instead of looking backward at last month's bank statement to see where your money went, AI provides a real-time, forward-looking perspective. It offers predictive alerts to help you avoid problems before they happen, and it runs complex simulations to help you visualize the potential future impact of your decisions today. So, what does this all mean for you? The most valuable way to view this revolution is to think of yourself as the CEO of your own personal enterprise. You Incorporated. In this model, artificial intelligence is not your new boss. It is your new, incredibly powerful chief financial officer and data analytics department. The AI's job is to be the expert analyst. It gathers the data, runs the numbers, creates the charts, and identifies the trends. It provides the dashboard with all the key metrics of your financial life. It can run thousands of scenarios and present you with data-driven projections. It handles the operational details with relentless efficiency. But you remain the CEO. You are the one who sets the vision and the strategy. You decide what the ultimate goals are, whether it's buying a home, achieving financial independence, or planning for retirement. You are the one who weighs the trade-offs, considers the risks, and makes the final strategic decisions. The AI provides information. You provide the wisdom, the judgment, and the intent. This partnership allows you to make decisions with a level of clarity and insight that was never before possible. As we conclude, it is vital to remember the principles we've discussed. We must remain mindful of the ethical questions surrounding data privacy and algorithmic fairness. And we must never forget that AI is a tool, not a replacement for our own engagement and understanding. Its most powerful contribution is its ability to boost our own financial literacy, empowering us to ask better questions and make more informed choices. The future of personal finance is here, and it is a future in which you are more connected to, and more in control of, your financial destiny than ever before. The technology will continue to evolve, but the core principles of sound financial management will remain. The architect of your financial life is, and always will be you. Thank you for joining us on this journey.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.